Welcome to this explainer where we're going to explore a pretty fascinating phenomenon in the financial world. What if I told you that some of the world's richest and most successful investors actually love it when a company's stock price gets cut entirely in half? It sounds completely crazy at first glance, right? I mean, why on earth would anyone want the price of their investment to drop so dramatically? Well, that is exactly what happens during a financial maneuver known as a stock split. Today, we're going to reveal the mechanics behind this strategy, why companies actually use it, and why this seemingly simple move can sometimes be a massive indicator of a winning company.
To understand why this matters, we have to look at one of the most famous investors in the world, Warren Buffett and his holding company, Berkshire Hathaway. Now, Buffett built his massive fortune through a very conservative strategy focused on value investing. And Berkshire Hathaway is incredibly unique because throughout its entire corporate history, it has literally never once executed a stock split. Because the company just kept growing and growing without ever dividing its shares, its stock became the most expensive publicly traded share on the planet. At one point, around early 2022, a single Class A share cost a staggering $460,000. Just let that sink in for a second. That's almost $500,000 just to own one single share of the company. And this brilliantly illustrates the exact problem that wildly successful companies eventually face. At those towering prices, regular people, everyday private investors like you and me, are completely locked out. We simply don't have a realistic chance to participate in that success story. Because of this massive barrier to entry, Berkshire Hathaway was eventually forced to create a second, much cheaper version of the stock known as Class B shares. Compared to that massive $460,000 price tag of a Class A share, the newly created Class B share was priced right around $307. It looks like an absolute bargain by comparison, doesn't it? This story shows us exactly what happens when a successful company refuses to split its stock. It just becomes way too expensive for the vast majority of investors.
Section 1. What is a stock split? Solving the pricing problem.
Okay, let's dive into this and uncover exactly how the vast majority of publicly traded companies use this maneuver to solve this very pricing problem, making sure they stay attractive and accessible to as many investors as possible over the long haul. In simple terms, a standard stock split, which is sometimes called a forward split, is a corporate action where a company reduces the nominal value or the price of each individual share while simultaneously increasing the total number of shares available. But here is the absolute most important takeaway from all of this. The company isn't losing any of its actual value. It's simply dividing that exact same overall market value into more, smaller pieces. The pie stays the exact same size. It's just sliced up a bit differently.
To really visualize this, think of it like a pizza. Imagine you order one large pizza and it arrives at your front door cut into 4 very big slices. It's one whole pie, representing the total value of the company, divided into 4 pieces, representing the shares.
Now, if you take those same 4 massive slices and cut them in half, giving you 8 smaller slices, you haven't magically created more food out of thin air, right? You still have the exact same size pizza, the exact same amount to eat. You just have more smaller pieces of it. That is precisely how a stock split functions. The company's total market capitalization doesn't change by a single penny during the split itself. It's just sliced differently so that each individual piece is smaller and way easier to digest for a new buyer.
So, why go through all this trouble? Well, usually it's driven by investor psychology. When a stock price grows significantly over a long period of time, it hits a level where new retail investors get a little intimidated. They look at the price and think, man, this stock is way too expensive, even if the company's financial metrics completely justify that high price tag. To prevent potential buyers from being too scared to buy in, companies announce a split using standard ratios, like 2 for 1, 3 for 2, 5 for 4, or even massive 10 for 1 splits. By bringing the high stock prices down to a much more comfortable psychological level, they hope to generate greater demand for the stock, which can theoretically lead to a rising price and a growing market value.
Section 2. The math for shareholders. What actually happens to your money?
Let's move on and break down the actual math for you as a shareholder. Because look, it's one thing to talk about pizzas and corporate strategy, but it is another thing entirely to open your brokerage account and see your own numbers changing. If you already hold stock in a company and that company decides to execute a 2 for 1 split, what actually happens to your money? Does your wealth suddenly double? Does it get cut in half? Let's look at a concrete example.
The math here is incredibly straightforward. Let's say you own one single share of a company, and it's currently trading at $100. Following a 2 for 1 split, your single share becomes 2 separate shares. The number of shares in your portfolio literally doubles overnight. However, the price of each individual share is immediately cut in half, dropping from $100 down to $50. If you multiply your 2 new shares by their new $50 price tag, you get $100. Your total account value stays exactly the same. Your overall position is completely unchanged. You just hold a higher quantity of that specific security. And this mathematical rule holds true regardless of the split ratio they use.
Section 3. Good or bad for investors? The reality behind the hype.
So the crucial point here is figuring out if this mathematical shift is genuinely good news for investors or just some clever illusion that looks nice on paper but does absolutely nothing in reality. Are splits inherently good or bad from a shareholder's perspective? Well, to answer that, we just have to look at the historical performance of stocks that have undergone splits. Historically, powerhouse tech companies like Amazon and Apple have split their stock multiple times throughout their corporate histories. And looking back, these actions have generally been highly rewarding for their shareholders. In fact, very often, just the mere announcement of an upcoming split causes the stock price to jump, kicking off a major price rally as investors get incredibly excited about the stock suddenly looking a lot more affordable.
But here is where we need to ground ourselves in reality for a second. It is absolutely critical to remember that a stock split is not a magic wand. You cannot just bet on the split itself being the sole driver of your future wealth. What really matters, the true secret behind the success of companies like Amazon and Apple, is that they possess outstanding, fundamentally strong business models. A split won't magically save a weak, struggling business. If the fundamental prospects of a company are poor, the excitement of a stock split will quickly fizzle out, and the long-term effect will totally vanish. The hype only translates to sustained, long-term gains if the underlying company is financially healthy, actively growing, and has a genuinely strong future narrative.
So the next time a stock split makes major financial headlines and everyone starts buzzing about a stock suddenly becoming cheap, I want you to ignore the hype. Look past the math, look past the sliced pizza, and ask yourself this one single vital question before you invest. Do you actually believe in the fundamental growth potential of the business itself? Because a sliced pie is only worth eating if the recipe was actually good to begin with, right? So looking at today's market, which massive, high-priced giant do you think is quietly preparing to slice their pie next?